afternoon, and I would like also to thank Professor Hoppe for the great honor and pleasure of being here, and for the wonderful and overwhelming hospitality. And I will continue the monetary subjects that Philip started. And I would like to bring to your attention the very significant and yet rarely discussed impact of monetary policy on any single individual's well-being. The subject of my talk will be the omnipresence of monetary policy.
So, having some technical troubles. We can wait.
Thank you. So, despite its substantial influence on daily affairs, monetary policy remains to a large extent outside the sphere of public debate. And this unhappy omission can certainly be explained, at least to some extent, by the very technicality of the subject, which I can assure you can indeed repulse even trained economists. However, such an obstacle would have been overcome if there were genuine awareness of the overwhelming social impact of monetary management by governments. It is therefore crucial first, I believe, to understand the very nature of monetary policy, and especially in relation to other forms of government interventionism. And second, on the ground of this insight, conclusions could be derived as to the consequences of this specific policy, which I hope would demonstrate its genuine omnipresence in our lives. So please allow me first to start with some general remarks about the government interference with the free market, with which you are certainly acquainted, but I believe they are important in order to be able to fully assess what really monetary policy is. So all government policies consist in altering the outcome of the free market, and this interference with the intentional actions of legitimate property owners can basically take three forms: taxation, regulation, and monopoly production. Now, taxation means the outright expropriation of producers of part or the whole of their wealth and income. It is the most visible form of redistribution that separates individuals into two distinct classes, namely that one of the exploited wealth producers and that other one of the exploiting wealth consumers. And following the intellectual tradition opened by the French classical liberals, the libertarians, they identify the exploiting wealth consumers with the constituent members of the state. The second form of state interference with the market in the regulation does not really imply outright expropriation. Rather, for various means, it aims at modifying the actions undertaken by part of the wealth producers or by all of them. For example, price manipulations through the imposition of maximum prices on consumer goods are meant to enhance the availability of the commodities for the less wealthy consumers. Regulation can also take the form of direct quantitative and qualitative restrictions on production and exchanges, when, for example, quotas and licenses are being enforced, together with limitations on contractual intercourse with specific groups of individuals. For instance, foreigners, physically enabled, but more conservative, or the representatives of specific race and gender. And classical economists have demonstrated that regulations fail to achieve their alleged goals, but only grant privileges to some at the expense of others. Regulation is therefore interestingly redistributed, and the more complex its system is, the more difficult it is to distinguish the exploiters from the exploited. Now, this distinction between these two classes is further blurred by the third manifestation of the state, that is monopoly production in some key areas. By establishing itself as a single territorial producer of essential useful services, the state aims at persuading the citizens of the utility of its own existence. Thus, it acquires legitimacy and as pointed by Professor Hoppe, lowers the social consciousness of the exploited. Therefore, resistance to increased taxation and regulation, that is to the other forms of state interference, is reduced, and the expansion of the state at the expense of voluntary cooperation and division of labor is thereby facilitated. Now, what I want to show you in the very nature of monetary policy is that monetary policy actually puts together all these features of complementary forms of interference in the market. And thereby, it is, I would claim, the most perfect form of governmental interference with our lives. So let me first start maybe with the working definition of monetary policy. It refers to the set of actions that the central bank follows in order to influence the total supply of media of exchange in a given economic area. Now, we do not need here to undertake a technical discussion of the goals and targets that the central bank will follow and the particular instruments that will be implemented on a daily basis in order to achieve these targets. The economically meaningful aspect of monetary policy is that it alters the total quantity of media of exchange in the economy, as well as the short-term interest rates on the capital market. From the outset, then, it appears that this policy pertains to the category of monopoly production. And indeed, in any given economic area, the central bank has the monopoly of producing the scriptural form of the domestic currency, that is, banknotes. The central bank is also in charge of regulating, supervising, and more importantly, refinancing the banking sector that de facto produces the fiduciary form of money, that is, deposits. And these deposits are being created by banks only because they have the privilege to operate on a fractional reserve bank basis, and thereby to create bank credit that does not represent previous savings. At the top of this two-tier banking system, the central bank alone determines the total quantity of media of exchange in the economy. But then, monetary policy turns out also to be a means of regulation. This is even more so as it sets the short-term interest rate on the interbank market for liquidities. Now, the manipulation of this interest rate, which can be considered as an example of price manipulation, may affect long-term investment decisions. On the free market, the interest rate regulates the supply of and the demand for present goods relative to future goods in such a way that the structure of production corresponds to the pattern of consumption today and in the future chosen by individuals. A manipulation of the short-term interest rate, which also implies a change in the total quantity of money, may induce production decisions that will be dissociated from consumption decisions by individuals, dissociated from the consumption plans. And here again, we have a confirmation of the classical findings later elaborated on by Mrs. Rollbrock in the Austrian School of Economics, that price controls in the monetary sphere are counterproductive and generate the boom-bust cycle. The last point that needs to be emphasized in order to fully circumscribe the nature of monetary policy is to establish to what extent it can be considered also as a form of taxation. But the production of paper money and the fractional reserve fiduciary media of exchange is substantially different from the production of commodity money, such as gold or silver coins, and fully covered money substitutes, such as deposits backed by 100% reserves. On the one hand, any increase in the quantity of commodity money requires recourse to additional physical resources, and the very cost of this operation imposed on gold and silver miners by the competition of other productive sectors limits naturally the quantity of money in the economy. Quite to the contrary, the production of paper money is not subject to this limitation and can go on infinitely at virtually no cost. The crucial point is that the quantity of paper money is increased without accomplishing any production-oriented action. while the standing of the new money allows the money producer to gain control on goods and services. On the other hand, any additional deposits that are not covered by corresponding bank reserves represent new fiduciary media of exchange that banks are able to create and then lend out only because they have the privilege to operate on a fractional reserve base. Any permanent increase in the fiduciary media of exchange allows, therefore, the issuer to produce more goods and services than otherwise, without engaging in any previous production activity. To raise the money supply in the economy appears, therefore, as a clear form of taxation, which allows the banking system as a whole, that is the monopolist producer of money, to seize part of the output of the wealth producers. And in Rothbard's terms, he, who produces his own paper money, could consume without producing, and thus seize the output of the economy from the genuine producers. In short, monetary policy turns out to be the most accomplished and complex form of state interference with the market economy, which combines all interventionist features. Now, provided that the higher money supply allows the money producer to seize part of the output of the economy, one would naturally expect the money supply to constantly grow over time. And this is exactly what the historical evidence shows. Now here you can admire the dollar money supply since 1959. The euro record is substantially identical, even worse. Since 1980, the euro money supply has been increasing by 7.7% per year. And since we are in Turkey, and for the sake of the third example, Turkish money supply has been increasing since 1986 by 59% per year. Now, of particular interest of this is the most visible impact of this continuous growth of the money supply that you can expect with governments to manage money production, is the continuous rise in the amount of money, is the erosion of the purchasing power of each single monetary unit. Now, the less scarce money becomes, which is the case that we observe relative to other goods and services, the less goods and services each monetary unit will be able to purchase. These changes in the purchasing power of money are causally related, therefore, to its overall quantity, even though that link is not automatic, neither rigid. Since any additional quantity of money is used in exchanges to acquire commodities, its progressive spending on the various goods, because it expresses an additional demand, brings about a progressive rise in goods prices. This is to say that as the new money changes hands and circulates throughout the economy, its purchasing power in terms of the different goods supplies decreases progressively. Now, historical evidence here that relates the quantity of money in an economy to estimates of the purchasing power of money is also very telling. The US dollar has lost 86% since 1959 in its purchasing power, which means basically that today $1 is buying only 14% of what it was able to buy in 1959. We have something very similar with the euro. €1 today is able to buy only 65% of what it was able to buy back in 1990. And in the case of Turkey, I wanted to date only until 1995, because there's a time when the Turkish lira has already lost 99% of its purchasing power for the last 10 years. Monetary policy, therefore, creates an inflationary environment that, beyond destroying the services rendered by each monetary unit, completely modifies individual incentives and undermines social cooperation. It favors indebtedness and spending at the expense of thriftiness and frugality. It is indeed in the proper interest of each actor to contract debts for at least two reasons. First, to the extent that the loan has been granted as a bank credit, this is the proper means to be the initial recipient of the new media of exchange created, and to spend them before their full inflationary impact has taken place. Second, to the extent that future inflation goes beyond expectations, the real cost of debt is lowered. Provided also that the real yield of savings is diminished, the incentive to accumulate is accordingly weak. And what historical evidence shows is a veritable explosion of debt. Now this is the total stock of debt in the United States, which I take as an example. Now in this environment also, individuals will tend to take credits, especially in order to acquire durable goods in the form of real and financial assets, the prices of which are expected to go up in the future, and thus to protect them against the erosion of money's purchasing power. This graph also substantiates these points, showing total mortgages, that is, debts taken by Americans in order to purchase houses in the US. And similar figures could be produced virtually for any country where the government produces money. Now this behavior implies that the prices of durable goods would increase more than that of consumption goods. And because the rates are used more to buy durable goods in order to protect against the erosion of purchasing power. And that's also something that historical evidence confirms. You can see here that the purchasing power of the US dollar in terms of houses was decreasing more than in terms of consumer goods. Even though this is not very pronounced in the dollar case, but in the euro case, since 1909, the euro purchasing power, when estimated in terms of real estate property, actually eroded twice more than when it is estimated in terms of consumer goods. Which means basically that with €1 today, you can buy only 0.45% roughly of what you were able to buy in terms of real estate property back in 1990. Now, overall, such an inflationary environment leads to a systematic decrease in the real value of any contract that has been stipulated in nominal monetary terms. Receivers of fixed incomes, such as pensioners and wage earners, are being spoliated by the beneficiaries of the new monetary units, that is, by the beneficiaries of the additional debt. And among the latter, acceding property owners and businessmen are an easily identifiable group. And thus monetary policy objectively creates the social conflict between proletariat and bourgeoisie that Marxists have wrongly identified with the functioning of the free market. And this conflict is further exacerbated by additional actions taken by wage earners to shelter themselves against inflation and by wrong entrepreneurial beliefs. On the one hand, wage earners take collective actions in order to obtain regular indexation, that is, regular increases of their nominal salaries. Trade unions obtain various privileges from governments that all encroach upon the freedom of association and increase the cost of labor for business. On the other hand, business profits appear artificially higher in this inflationary environment since revenues depend on current prices, while investment costs are calculated on a historical basis. Economic calculation then loses its accuracy and establishes conditions that actually favor capital consumption. Monetary policy is therefore fundamentally anti-social, for it disrupts the very foundations of civilization: capital accumulation, rational calculus, and inventive entrepreneurship. Since the best strategy for the property owners and for businessmen is to satisfy first the preferences of the loan granting banks rather than those of the consumers, the economic structure is inevitably reshaped according to the wishes of the monopolist producer of money. The network of dependencies that thus emerges, businessmen dependent on banks and banks dependent for their refinancing on the central bank. So this network of dependencies, I believe, is a perfect illustration of the voluntary servitude by which the policy described tyrannical governments. By accepting and using field paper money and the fiduciary media exchange that are redeemable in it, we actually submit ourselves to an ever-growing government that de facto directs all sectors of economic activity. And the first step towards the liberation from this technologically perfected and complete form of intrusion in our lives will be to advance the understanding of monetary policy's nature, which then I hope should receive its well-deserved attention in public debate. Thank you.